All right, good evening, guys. My name is Jami Olakunle. I'll be facilitating today's class on bank reconciliation. Um, okay, let's get started. The scheme of the lesson is as follows. At the end of today's lesson, you should be able to do the following. Number one, you should be able to define bank reconciliation. You should be able to also establish the importance of bank reconciliation. It's important for you to be able to compare and contrast very well the following: cash book, bank statement, and bank reconciliation statement. When we are done, we should also be able to identify the factors that are responsible for the differences between a cash book and bank statement. And number four, we should be able to identify key steps that are involved in preparing bank reconciliation. The fifth objective will be for you to know how to prepare adjusted cash book, and at the end of the day, lastly, prepare a bank reconciliation. So let's get started. What is bank reconciliation? Bank reconciliation is nothing but the process of comparing the balance in the bank column of a cash book with that of a bank statement of a given reporting entity and at a particular date. Now, you must understand that it is a process, it is not a statement. Bank reconciliation is not a statement, it's a process of trying to compare items that are in the bank column of a cash book prepared by a reporting entity and those items that are also in the bank statement. And it's usually for a particular entity at a particular point in time. And as you do this, you also note and be able to explain certain differences that might have occurred. So we can also refer to bank reconciliation as an exercise that seeks to ensure no other thing than you know making sure that the transactions posted to the bank column of a given cash book are made to reflect in the bank statement so that at the end of the day the balance that you will see in the cash book will also be the balance that will be in the bank statement. So you can see that image. You can see bank reconciliation trying to look at cash book on one hand with $1,500 balance and the bank statement balance having 1,760. This is clearly not what a firm will look forward to. So the custodian of a cash book, the owner of a business, will only be able to go to bed comfortably with his two eyes closed, having ensured that the balance in his cash book that he has prepared in-house is the same as the balance in the bank statement. You can see 1,500 and one in the cash book and 1,760. If care is not taken, a lot of problem may be brewing, and so it's important that that difference of 260 that you're seeing there should be properly located, clearly, meticulously located, and resolved, so that the balance that you now see in the cash book will now be the balance that you see in the bank statement. So what then are the importance of bank reconciliation? We have many of them, but we'll quickly look at some of them. Number one, the bank reconciliation gives a reporting entity greater confidence in the amount of cash that it has on hand. If you look at the example that I showed you earlier, the firm might be thinking that he has $1,500, whereas it might be $1,760 that he really has on hand. So it's important that at that point in time, you do bank reconciliation so that this confidence is there to know that the exact amount of cash that you have on hand, so that you don't over project or under project or over report or under report. Again, bank reconciliation helps to reduce the incidence of bounce checks. When you issue a check and you ask somebody to go to the bank to present that check, for some reasons, the bank may not give value, for that check. So it's important to be able to do this exercise to know whether, okay, this check has been given value or not, so that a check that has been dishonored by the bank can be identified and the issues are corrected, addressed, so that such a check can be represented. So we also a bank reconciliation also helps to offer insight into which customer or supply payment have failed to enable better decision making around attempting to collect payment. So if you have a customer now that is owing the firm, how would you establish, whether this customer has actually paid or not? Or if the firm, on the other hand, is the one, owing the supplier and he has made payment, but the supplier has not received this payment, then that will surely be an issue, and this can, you know, cause that business relationship to break down irretrievably. So preparing bank reconciliation also makes the book cleaner. And what do we mean by this? You reduce incidences of errors. Errors can come as you prepare one cash book, and error can also come, on the part of the bank, can occur on the back of the bank. So preparing bank reconciliation, especially when it's done often, can help address this issue. So it engenders greater confidence to attract investors because you know how much you're actually worth in terms of cash. Then, lastly, it enables timely fraud detection. These key points are by no means exhaustive. There are many other benefits that we can derive from paying bank reconciliation, but I think these six are very, very critical that I want you to pay attention to. So, we move on to cash book, bank statement, and bank reconciliation. For us to have a good grasp of bank reconciliation, it's important to know what a cash book is or revise what we have discussed under cash book, compare this with bank statements, and try to establish a link between the cash book and the bank statement so that that will now take us to bank reconciliation statement. What then is a cash book? A cash book is that ledger, is a book of accounts that does one thing. It is used in recording all cash receipts and cash expenses. So cash-based transactions that involve cash. If it does not involve cash, it doesn't come into the cash book. It's important to let you know that there are different variants of cash book. We have a one column cash book, we have two column cash book, and we have three column cash book. Now, bank reconciliation does not really work with one column cash book because you only have one column. That column is just essentially cash. It works when you have minimum of two column and three column cash book, whereby in the two column cash book, you have a column for bank and a column for cash. So that if you take any money to the bank, you can record it under the bank column. And if you take money from the bank, you bring money from the bank and you turn it to cash, it can be under the cash column. So it also applies for three column cash book. And that is why if you look at that earlier definition, we said that we focus on the transactions under the bank column of the cash book, not the cash column of the cash book. And you can obviously not have that when you are preparing one column cash book. So the second one is a bank statement. What's a bank statement? A bank statement is a statement sent at regular intervals by bank to its customers. And what does it contain? It contains a lot of information. But the most fundamental of this information is that it shows the list of all lodgements, all withdrawals, and charges as recorded in the account for the entity. So it's important that you pay attention to those points that have been highlighted. Then, what is a bank reconciliation? It is when we compare the transactions in the cash book and we look at the transactions in the bank statement. They are not the same. And at the end of the day, the balance in the cash book under the bank column is not the same thing as the balance in the bank statement. Then that will naturally, trigger that process of bank reconciliation. And the end result is the preparation of a statement. And what then is that statement? Is the bank reconciliation statement. So that goes for BRS, that's called BRS for short. And it is a periodic statement prepared by entities account staff. So in order to bring the cash book balance into agreement with the bank statement, with the bank statement received from the bank. This is the end point of a bank reconciliation exercise. Everything terminates with the preparation of a bank reconciliation statement. So it's an important statement because at the end of the day, if you want to establish whether you're right or not, all you have to look at is if the balance you have in the bank statement, so it's the same as the balance that you have in your bank reconciliation statement, then you can then say, oh, you have been able to identify all reconciling entries, reconciling items, and that those factors responsible for the difference between the cash book and the bank statement have been identified and corrected. You can pass necessary adjustment in your book of account. So we move on to the next one. So what then does a bank statement look like? Can we see? This is an example of a statement issued by HSBC on 20th July 2009. If you look at this, you have a good idea as to what a bank statement looks like. So it will tell you the account type, the account name, account number, so branch identifier code. HSBC is an international bank, and you typically see all this information there. But I wish to quickly draw your attention to other important attributes of the bank statement. For instance, you'll see the column There's a column for date. There's a column for the nature of transactions that have occurred, in the customer's account with the bank. Now, the column after that column is for debit entry. The column after that one to the right is credit entry, and the last column there is for balance, account balance. So you see that on 20th July, the balance brought forward is 6,450.06. Now, a transaction occurred on the 22nd July. VIS is the identifier for that transaction, and it's a debit. A debit means a withdrawal is being made, and you see that withdrawal of 11.46. That 11.46 has reduced the balance brought forward of 6,450.06 to 6,436. But then, if you look at what happened on the 3rd of July with identifier CR, you will see that there was a credit entry of 39, and that 39 increased the balance before that date from 4,423.60 now to 4,362.60. So this is what a bank statement actually looks like. So what then are the factors that cause or that are responsible for the difference between the cash book and the bank statement? We have a lot of them. So we'll quickly look at some of them. Number one is unpresented checks. What are unpresented checks? Unpresented checks are checks that a reporting entity, a customer of a bank has issued, but the beneficiary of that customer has not taken that check to the bank. Now, what will happen is that the balance in the cash book would have been reduced compared to the balance in the bank statement. And the banks, do not have crystal ball to know what checks have been issued by their customers. It's until those checks have been presented before they can give value for it. So that would naturally throw the cash book off balance. It will throw the bank statement off balance with the cash book. So it's a check that has been issued, but which is yet to be taken to the bank so that value can be given for it by the bank. So the other one is uncredited check, very similar to unpresented check, but just that this time around, the customer, we are the one that have received that check. We have received the check, and by receiving, we debit our cash book in line with normal posting rules into the cash book. We debit our cash book. Then what happened? Then you take this check to the bank, but for some reason that includes clearing, so the bank is here to give value for it. So the implication of this is you would see that the balance in your cash book will be higher than the balance in your bank statement. The bank has not credited you, because if they have credited you, the other things being equal, the balance in your cash book will be the balance in your bank statement. So I move on to bank charges. Banks are not they are not running charities for the accounts you have with them and for other services that they rent, that they charge you. And when they charge you, sometimes you might not be aware that they have charged you. And of course, a charge on your account means that they will do a debit there. And when they do a debit, so the balance in that bank account will reduce compare with the balance that you have in your cash book. It is until you have been notified that you can now go to your own cash book and credit. But if you are not notified, which is most times the case, you'll find out that the balance you have in your bank account will be lower, will be smaller compared with the balance you have in your cash book. So we have standing orders. Standing orders are express instructions given by a customer of the bank. So asking the bank to defray certain obligations as they fall due on his behalf. So it's a specific instruction. It's very, very clear. Now, what normally happens is this. When these obligations fall due and the bank makes this payment on behalf of their customers, you will find that the customer might not be aware that these obligations have been settled. And now, what will happen? The balance in the bank statement will be lower than the balance in the cash book. So I move on to dishonor checks. Dishonor checks, are checks that have been presented, not the checks that the bank have received and they've not credited. So the bank have received it for reasons that includes um, discrepancy between amounts in words and in naira, torn check, outdated check, mutilated check. The bank may refuse to give value. When such happens, such checks are to be returned to the customer. Now, what this will do to our bank statement balance is that our bank statement balance will be higher when compared to the cash book balance. We have issued that check. We have issued the check, and what has happened? So the check now, we have credited our cash book, but the bank did not pay. So the issue of dishonored checks can come in two ways. It's either we are the one issuing that check or they are giving the check to us. And that's why when you are treating it as a reconciling item, as a factor responsible for the difference between the cash book and the bank statement, you have to be very careful. It depends on who issues this check. So if you are the one that issues that check, the mechanism is that, or the mechanics is that we would have credited our cash book, but the bank refused to pay us. It means that the balance in our bank statement will be higher compared with the balance in our cash book. But if we are the beneficiary, the moment we collect that check and we debit our cash book, we take the check to the bank and the bank refuse to pay us. You know what would have happened? Now, our cash book balance will be unduly higher compared with our bank statement balance. Definitely, the balance in the cash book and will not be the same. So credit transfer, in this digital era where everything's are done technologically, electronically. So there might be some, wire of funds into our bank account for which we have no knowledge. So we don't have any information about that transfer. So how are we supposed to know? So what will happen is the balance we have in our bank statement, the balance in our bank statement, other things meaningful will be higher than what we have in the cash book. So errors, very, very important. Errors can occur on the part of the bank and also occur on the part of the cashier. So, and then how can it occur? On the part of the cashier, we can have about four of such types of errors. Number one, if it's a payment, we can have payment on the cast, we can have payment over cast. For receipt, that is money coming in, we can have receipt over cast, we can have receipt on the cast. So how you treat it depends, and you will see how this is treated in the pro forma that will be given to us in the course of these lectures. Dividends. So companies are the customer are firm for which we are doing this bank conciliation may have invested in a lot of companies and they are paying dividends. And these dividends may just be paid directly into our bank account. And we may not have this information. So what we'll now do is our bank account has gone up. So what we'll now do is we'll now have to come to our cash book to mimic what has happened in the bank by also what? By also debiting our cash book. So wiring the dividends into our bank account will make the balance in the bank statement to be higher than what we have in the cash book. So now, what steps are to be taken in carrying out bank conciliation? So, number one, you tick items on the debit side of the cash book against items on the credit side of the bank statement. So, we have to get the cash book on one hand and the bank statement on the other. Look at those items on the debit side of the cash book, and we expect all the items on the debit side of the cash book to be the items that you see on the credit side of the bank statement. So, if you see any difference, so this difference will represent most likely uncredited checks. So list all these items. You list them one after the other. So the other one is you take items on the credit side of the cash book against items on the debit side of the bank statement. So now it's just the opposite of the first one. This time around, we are focusing on the credit side of the cash book against the debit side of the bank statement. If there are any outstanding items, those outstanding items will most certainly represent uncredited checks. The third one, the remaining items on the debit side of bank statement, remaining items on the debit side of bank statement will then represent bank charges and standing order. So you also are expected to take cognizance of these two items. So in furtherance, the remaining items on the credit side of the bank statement are amounts paid into the bank directly by the entity customer. So if the items are not on unpresented check and they are not uncredited checks and they are not bank charges and they are not standing orders, so whatever items you see there will most likely, if they are on the credit side of the bank statement, they are items paid directly and they are all called direct credit. So you are also expected to what? To list them. After this adjustment, reconciliation should then be possible unless there are errors which will be reviewed by further investigation and traced back to the sources. So armed with this invaluable information, you can then proceed to prepare number one, adjusted cash book, and number two, bank reconciliation statement. So how do we adjust? How do we prepare adjusted cash book? How do we prepare adjusted cash book? So this is a cash book prepared that takes into consideration transactions that have appeared in the bank statement but not in the cash book. Transactions that we have seen in the bank statement but not in the cash book. That is what it addresses. So, and it is designed to present what the transaction would have been if the what the cash book would have been if the transactions to which the reporting entity was not privy had been posted, had been issued. That is at the beginning. So how does the format look like? You can see the format of an adjusted cash book. Ghana International Limited adjusted cash book for the month ended 31st December 2019. You see the balance brought down, the credit transfer on the debit side, the surname check on the debit side, dividends on the debit side, balance brought down again on the credit side. So that is where we have more credit, more entries on the credit side than entries we have on the debit side. That is the credit side outweighs the debit side. That is when you have the other balance brought down on the credit side of the adjusted cash book. It's not in all cases. In fact, it's not in all cases that you see two balance brought down. It has to be one. It's either the balance brought down is on the debit side or is on the credit side. You have it on the debit side if the balance if the total on the debit side is higher than the total on the credit side. And you have it here, however, on the credit side, if the total on the credit side is higher than what we have on the debit side. So credit transfer, the SONO checks, dividends, then you have standing order, we have bank charges, we have the SONO check. So you see the SONO check on the credit side, you can also see it on the debit side. And that, fit into my earlier explanation that you should be open as to, if you see any question on the SONO check, it can be on the debit side, it can be on the credit side. So we have errors. So if you have receipt on the card, it's going to be on the debit side. Payment on the card, you see that also on the debit side. Receipt over cards on the credit side, then payment on the card also on the credit side. So whatever balance you have, the balance can be on the debit side. The balance carried down can be on the debit side, can also be on the credit side. So you should be open. So you see it on the credit side where the total, the aggregate of what you have on the debit side is higher than the aggregate of what you have on the credit side. However, so the balance carried down will be on the debit side if the aggregate on the credit side is higher than the aggregate on the debit side. So this area is very, very important. Where are these items coming from? The standing order, credit transfer, the surname check, dividends, etc. Where they are coming from is the bank statement, except for errors that occurred in-house. So except for those 4 errors, other ones are taken from the bank statement. So bank reconciliation statement is a periodic statement, as we noted earlier, prepared by entities account staff in order to bring the cash book balance, bank column, emphasis on bank column, into agreement with the bank statement balance. And what does it help us do? It helps us determine what the correct balance in the bank account would have been if the bank was aware of the transactions that were posted into the cash book, but which have not appeared in the bank statement. We have posted those entries in our cash book, but the bank is not aware of all of these postings. So until they are aware before they can post. So we use bank conciliation to, cause the cash book to agree with the bank, with the balance in the bank statement. So that is the format you see there. So the balance as per adjusted cash book is the balance that you have, the balance CD that you have in the adjusted cash book there. And it is remarkable to note that bank conciliation statement is only prepared as at a point in time, unlike adjusted cash book that is for the period or for the month of maybe for the month of December as I've used in this case. So, and how does it work? You have balance as per adjusted cash book coming straight from the adjusted cash book. Then you had unpresented check. Errors that increase bank balance are added. So then you deduct. So uncredited checks, and you also deduct errors that decrease bank balance. At the end of the day, what you come to is the balance per bank statement. So conclusion, summary and conclusion. We have we have established that we have explained that bank reconciliation is a process of comparing the balance in the bank column of the cash book with that of a bank statement of a given important entity and at a particular date, while noting and explaining reasons for the differences between these items. So it is an exercise that involves comparing what we have in the bank column of the cash book with what we have in our bank statement. So then there are many factors that are responsible for the differences between the balance per bank statement and the balance per cash book, some of which are unpresented checks, uncredited checks, and bank charges. Preparing bank reconciliation gives greater confidence in the amount of cash that the firm has on hand. So now, having explained all of this, let us take an illustrative exercise. That's the next one. So before we take this exercise, I hope you've had a wonderful time listening to these lectures. If there are clarifications, if there are questions that you want to ask, you can entertain it on our WhatsApp platform, on our Telegram platform, or on our Zoom platform. So please drop your concerns, let me know. So as a way to take an illustrative exercise, I hope you've had a fabulous time. So thank you so very much.